Hello everyone, can you please confirm whether we
Yeah,
are
now
live?
it is live. Ankit, we can start. It's live now.
Okay, sorry for the confusion. We actually, from the back end, we went live on a different separate link. So no worries, we are going to be starting from the beginning.
Okay. Okay.
All right,
So,
Vivek, over to you.
yeah. So, I'll just quickly take you through our Gulaq gear-based methodology for the new investors. So, in this, we believe that investors should invest in the portfolios which are meant for their risk profile. And as we all know, the more aggressive an investor is, the more equity he or she can have, and that's why we have created these gear-based portfolios, in which Gear 6 has 100% equity meant for purely aggressive investors. Gear 5 has 80 equity and uh, 20 debt, so it's meant for moderate to aggressive investors. Gear 4 has 60% equity, 40% debt, so meant for moderate investors. And for conservative investors, we have Gear 3, which is 40% equity and 60% debt. In terms of weightages, for Jan portfolio, in large cap, we reduced our weightage to 13% and increased in mid and small cap. So now mid and small cap are about 45 and 42% respectively, and large cap is at 13%. In terms of sector weightage, we have increased our weightage in consumer staples, materials, industrials, communications. These two, consumer staples and materials, new stocks have been added. And real estate, IT goes down to zero, and energy, consumer discretionary, and healthcare also have been reduced now. In terms of factor weightages, it remains pretty much the same as last month. Quality and value, quality gets 24% and value is at 76%. These are the factors that we use to construct our portfolios every month. In terms of performance, our performance over the short run is matter of concern. It's underperforming over short run. Obviously, over long run, we have produced pretty great results. We totally understand that all the investors who have joined us in the recent past would be sitting on some losses, whereas the longer term investors are doing just fine here. Uh, Similar is the story in Gear 5 because our equity component is exactly the same in all of these gears. So even in this portfolio, short-term underperformance we see. Longer run, we have produced great results in spite of these short-term performance. Gear 4 was launched later, so we just have 3-year track record here. And similar is the story here that over 1 to 2 years we have underperformed. Longer run it is outperforming. Here it's slightly different, just because in 1 and 2 year we have some alpha, although it's quite negligible, but because we have 60% debt here and 40% equity, and that's why even in 1 and 2 year it has performed. Uh, and since May 2020, even with a 40% equity here, we have given decent results here. So this is the overall performance across gears and across time frames. We also launched our market cap based portfolios in December 24, and here is the results since inception. Because it's been about 14 months or so, and short term the models are underperforming, and hence we see underperformance in the large cap and in mid cap. Obviously, longer term expectations are there based on the backtested results, but short term, yeah, it is underperforming. The small cap has given some bit of outperformance, although it's again quite negligible, but it's kind of tracking the Nifty small cap index. Yeah. We also started um uploading few long form videos on YouTube, and it will be great if you are interested in these topics, should go and check these out. So one we we uploaded this video on retirement planning and why 25 times annual expenses fail in India, which is the very popular 4% rule, why it does not work in Indian case. And secondly, it's about our quant-based methodology in this specific one. We talk about what we are doing exactly in the quant-based methodology. Yeah. So let's move on to the Q&A. So we received few questions here. Largely they are around performance and recovery. And regarding performance, obviously, anyone who has joined us in last 1 or 2 years has seen the kind of underperformance and haven't really tasted the returns that we have been able to give in the previous few years. And people are really anxious about the performance here. We'll take this up. Then obviously it's about recovery that we have gone down. When is it that we expect the recovery would happen? And in terms of strategy, what's our strategy like? So I'll start with the strategy first. So in Gulaq, we're using the multi-factor strategy. What do we mean by multi-factor strategy? That we have more than 100 plus factors, and we have backtested it and we have figured out, and these factors are a mix of all fundamentals and technicals, and we have figured out that which kind of markets, which factors work well. In the rising markets, in the trending markets, factors like growth and momentum work really well, whereas in the flattish to bearish markets, factors like quality and value work well. And that's what we are doing. So our value add is in defining these factors well, and the second stage is how do we allocate weights to these factors. So in a nutshell, that is the strategy. Now, what has happened in the last 1 to 2 years is this strategy obviously hasn't performed as expected. Over last 5 6 years, we have seen 4 years where we did great, and last 2 years have been underperforming. And this is, I wouldn't say really expected, but this kind of uh, underperformance keeps happening in active strategies. There is no active strategy really which can outperform markets year after year after year. So that is very, very difficult to do. I don't know even of any any mutual fund or any other small case which does this kind of performance very, very consistently. So it's a part and parcel of active investment. That's the risk we all are taking. Our money, everyone's money in Gulaq and ST is also invested in these strategies. So we are in the same boat and we have skin in the game. And yeah, in the short run, it's not performing, but overall, what is expected is, I would say that over long run, yeah, 2 years is slightly still lot. You've shown a lot of patience, but I would say give it some more time, because as soon as what happens in these kind of strategies is the outperformance is huge. Whenever it does outperform, it is able to give 10, 15, 20, 25% kind of outperformance. And that's what we have seen in the past. And that would be my expectation, that as soon as maybe we saw some momentum, but then it fizzled out. As soon as we start seeing some bit of momentum, I think the recovery should come in these, and we should start seeing those kind of outperformance that we have seen in the past. So I would say it's just slightly about the market momentum also. At the same time, from our side also, our research team is totally working on it. We are trying to figure out exactly how can we improve our strategies even in the flattish to downwards market. And pretty soon we'll be updating our portfolios as well. But in most likely 2026 is going to be the year where we break out, because it's been some time. It's been almost more than 1.5 years where we have stayed below the all-time high. As soon as we break out of that, that would be the time, in my expectation, that will be the time when we start seeing some decent outperformance. So, and it's very hard to say when that will happen. Short term, we really can't predict, but you've got to wait and watch here in this case. In case of rebalance, we have noticed frequent churn and sometimes the same names being bought, sold across rebalances. What drives this behavior? How do you balance responsiveness with turnover, and how do you evaluate whether churn is adding value net of costs? So, uh, whatever methodology we use, we backtest it exhaustively and see how it has performed in the historical markets, and we backtest it over 12 plus years of data, and we see its performance in all kinds of market phases, be it flat market or rising markets or falling markets, and then we actually implement that specific methodology. So this kind of thing that uh, sometimes few names we select few names within a few months we exit it and then again they come back. It's because of the methodology that every month we take in the new data that has come in, rank all the stocks based on the factors we are selecting, and even though the factors that we are selecting is same, the ranking of these stocks and sectors can change. And that is why there is some churn. Over the past couple of years, what we have done is we have tried to reduce the churn, and which has helped us in definitely avoiding slippages, avoiding brokerage cost. But but by nature, quant strategies as compared to discretionary style, they are quant strategies are high churn strategies. You're never going to see the kind of churn that is seen in the discretionary strategies. So quant by nature would always be high churn. There's going to be some uh, mm, uh, in some cases these kind of things are going to happen, that we select a stock, it goes out and then it comes in. But see, this is the same methodology we used to make money. When it was working well, it was really working well and it was working in our favor and giving great results. Now, same methodology during last 1.5 years hasn't been working that great. But we believe in this methodology, and over long run, it has produced great results, and we expect it to produce great results even in the future. So, yeah, risk management: when a stock faces sudden adverse news and a sharp fall, what is your risk protocol? Do you ever intervene outside the scheduled rebalance, and what criteria guides this decision? So, again, in this specific case, also, this has been uh, proposed multiple times that in case a stock is going down, we should have some sort of stop loss in place so that it does not uh, lose great value. What happens is, what we have done is we have actually back tested this specific thing also, right? The results really were not very encouraging, because what happens most of the times is, in couple of days, whenever the news comes out, we see a very sudden sharp movement. Most of the times what happens is the price gets corrected very fast, and all the bad news is built into the price. So it's very hard uh, to really, obviously it's very hard to predict, but at the same time, if you get out of that stock at that point of time, many a times what happens is that might be the low, because all the bad news is built into the price has already corrected, and then when you get out, you are getting out near the lows only. So I'm not saying that happens all the time, but many times that happens. And that's why if you follow this strategy of having a stop loss, over long run, it does not really add any value to the overall returns. Neither in terms of increased returns and nor in terms of reduced risk. And that's why we haven't made that specific methodology live of having stop losses in place. But at the same time, we are all the stocks that we do select in our portfolio. we are tracking that on a daily basis. Uh, our protocol is not to really intervene, but in rarest of rare cases, we might intervene. Till now, it hasn't been the case. We haven't seen any such case, but we are not saying we'll never do it. We do watch it very closely. In rarest of rare cases, we might do it, but as a protocol, we don't touch these stocks. As a rule, we let it continue for a month and then only rebalance. So, can you share how you plan to improve visibility into what changed and why after each rebalance so investors can track the rationale and not just the trades? Yeah, I think this is a good suggestion, but in this case, I think whatever we are already sharing a lot, and we are sharing. I think the biggest thing is the factor weightages that we do. Primarily, it is because of that specific those specific changes that the churn happens, that few stocks get selected or few stocks get removed. Apart from that, if you have a very direct suggestion, we are happy to look at it and see. See, we are all for the uh, transparency, but at the same time, what happens in these strategies is there's a lot of data involved. Now, when I share the data as to how we are reaching that specific weightages, it's not really going to make lot of sense because there's huge bunch of just numbers and numbers out there. So really, you really can't make sense out of it a lot. But if you have any specific suggestion as to something specific that we should share more, we will be happy to look at it. And if it makes sense, we'll definitely be sharing. So please put down in comments if you feel there is something that we should share more, and we'll be happy to look into that. Yeah. But Ankit, and any suggestions? You have anything in mind? You feel we can share more, which will make sense and help investors assess what we are doing in the background?
We do share the rationale for each and every trade, but we do not share the scores, factor scores, but we do share because of which factor we are selecting a particular stock. So whatever stock that you see in the buy list, we always give out a rationale. If you click the investment research report in your small case, you will
On small
see
case.
because
Mhm.
of which factor the stock was included. Apart from that, if you guys have any suggestions of what more information you would want to know, we would be happy to accommodate that.
Yeah. Okay. Then we have one more question regarding NRI, who says that wearing ticket size, NRIs face higher slippages, brokerages. What's our guidance would be? Would you give on suitability, expected frictions, and how to decide? Yeah, I think this is something that people have reached out to us because NRIs usually have very high brokerage, and because these quant strategies have higher churn, the brokerage cost for them is significant. Now, I'm not sure how much you can negotiate, but typically brokers do negotiate. So, if you talk to your broker and you show them the kind of churn and the volumes that you are doing on a monthly basis, many a times brokers are negotiating and they offer better brokerage rates. So, that is something that you can do. Apart from that, you can check your uh, the AUM, what the kind of AUM that is invested, because if the AUM is say anywhere closer to 50 lakhs, which would make sense for you to invest in our PMS, where the brokerage rates would be zero. And because we are rebalancing your portfolio, we are able to do it more efficiently. So that is something that if it is closer to 50 lakhs, maybe you can have a look at our PMS. But otherwise, also you should definitely talk to your broker and uh, see if they are able to bring your rates down on the brokerages. Yeah. 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 Yeah.
Thank you,
Any more
Vivek.
questions, Ankit? Any more type of questions?
We do have a lot of comments, but most of the comments are investors expressing their concerns regarding the performance and the stock selection. Let me see if I can pick a few of the questions that we can address. One of the questions from Sahil is that Chinese that tech was a falling knife. We bought it in the middle and sold it at the bottom. Uh, how do you justify that stock selection?
Which specific stock, Ankit?
Chinese.
Okay. Okay. See, yeah, see, it's been our policy to not really comment on an individual stock, and because what happens is frankly, I can totally understand why there's a lot of questions around the performance because the results are not coming. But if you just look at what happened since we launched our portfolio May 2020 till maybe about for the first 4 years or so, this same methodology uh, we were using and it was giving very good results, right? And obviously at that time also we were making mistakes. It's not that all the 12 to 15 stocks that we were selecting at that point of time were in profit. There were few in profit, but then also there were few in loss. And exactly this thing was happening. The stocks which were in loss, we were doing exactly the same thing, that we were buying and selling at the bottom. But overall, at a portfolio level, we were doing fine. And that's why investors were not really concerned that why are we losing in the stocks. Now I can, and I'm not blaming anyone here. It's totally justified that it's investors' hard-earned money, and if they're not seeing the results, they'll definitely going to ask questions. They are going to ask a lot of questions, and that's why we are here. So my point is, this exact same methodology was producing huge, very good results, and we were losing money even at that point of time in some stocks. But overall, at a portfolio level, we were doing good. Now, the concern is that obviously these stocks are losing money, but at a portfolio level, because we are underperforming, that's why investors are drilling down deeper and looking into those specific stocks that are losing money. Uh, Frankly, that is not the right way. The right way is obviously to look at it at the portfolio level, because there's always going to be few losers in the portfolio. So that's what I have to say, that that's not the right way to look at it. The right way to look at it is at the portfolio level, and I can totally imagine, because it is underperforming. That's why there are a lot of questions around performance.
Absolutely, Vivek. And in quant strategy, we always create a portfolio because the interaction between the constituents becomes very important. And that is why whenever we address investors, we never comment on an individual stock because its presence might not be justified by its individuality, but also because of its interaction with rest of the constituents in the portfolio. Uh, we have some more comments. Mr. Mishra again is asking, why don't we skip rebalance since at times we end up with a repeated buy in a span of 3 to 4 months? It will reduce the churn. Are we lacking in some research?
See, again, this is, I would want to comment by saying, see, there was another suggestion a couple of months back and also previous few years, that why is it needed that we do rebalance monthly? Why don't we do the rebalance on need basis? As soon as we feel that a stock is really not performing, we remove it and then select few other stocks. So need-based rebalancing, and that could happen anytime really. That would reduce the churn also a lot. So we actually went back to the drawing board and see how that specific strategy would perform. And again, in our opinion, the current strategy is the best strategy, the one that does the need-based rebalancing. Obviously, it reduces the churn and hence reduces the slippages and the brokerage cost, but the overall alpha also gets reduced drastically. So net investors are worse off, right? Even with lower brokerage cost. So we have back tested those kind of methods also, but overall the current methodology of rebalancing every month makes more sense.
We have another investor seeking some insight into what goes behind the scene. He's interested in knowing has there been any change in the management, employees, or the research team which is building the portfolio?
Yeah, yeah. I think that's a good question. That's the way one should look at. Maybe I would also want to look at that specific thing. What has changed really? And what I have to say is really nothing has changed. Our research team is led by our CEO Sandeep Tyagi, and there's research head, and then there's the investment committee, and then there are research analysts. Our research team, investment committee, research head, everyone has been in the same role for the past 7+ years. So nothing really has changed in the past 7 years. It's that same team which has produced earlier great results, and we hope we'll definitely produce good results in the future. I totally agree. It's testing a lot of investors' patience. But what I have to say is, see, our money, my personal money, is also a significant part is invested here in these strategies. So we do have our skin in the game. It's not that we are managing your money, we are managing our own money also through these strategies. So we are doing everything in our capacity to set it right. It is testing patience, but I'm hopeful it'll turn around. And when it does turn around, we have seen in the past, whenever it does turn around and when it starts working, it produces phenomenal alpha as per historical data that you see, not only in backtest but in live also. We have done that, right? So that's my expectation. I don't know when that's going to happen, but as soon as it starts happening, you're going to see those good times back again.
Hopefully. On that note, another user, Navi, is asking, you guys call yourself expert, but say that you cannot predict the market. So why should we invest with you?
I don't think any one of us calls us ourselves experts, really. Frankly, we don't view ourselves. But see, there are few things which are not in our control. There are few things which we are good at, which we understand. So what we try and do is, and I think that's what I've seen with many good managers, that they stay within, they're very much aware of what their strengths are and what their weaknesses are, what they are not good at. And they don't try and do things that they are not good at, right? So when we say we can't predict the market, we know we can't predict the market. We have done a lot of research around market prediction, and that would be that, let's say if our view is that markets are going to fall, we switch to cash, we move to cash and move back to equity when the market starts rising, those kind of things. So we have tested a lot of methodologies around it. Frankly, none of those methodologies we have been able to make it work. We feel it's very hard. There are very, very few maybe who can do it well. We really we can't predict the market. What we can do is pick stocks and create those portfolios, right? That's what we are good at, and that's what we'll stick to. We are not going to do anything that we are not good at. You look at any good manager, and one of the best manager, obviously, who has just retired, Warren Buffett, and he really inspires. His methodology or the way of looking at things really inspires us a lot. And that's what he also says, that he wants to stick to his style of investing. And he has been very patient for the past many years. I think they have been holding huge amounts of cash just because they are not getting very good opportunities. At times they have underperformed for a very long time, but overall, that's what they do well. They don't try to predict the markets. So I think that's what, in every profession you have got to figure out where you are good at, and stick to that specific area of competence. That's what I have to say about this.
That's very well said, Vivek. Some investors are also saying that it's now been quite long since we have been underperforming. In fact, for 2 year investment horizon as well, our historical record is negative and below the benchmark.
Yeah.
So, what sort of analysis have we done on the underperformance?
Yeah. So what we are going to do is, I think in the next month, because we just finished the year, and after we finish the year, we do a thorough analysis of what worked, what didn't work, what we have learned. So I think that is something that is still pending. We have not finished with that analysis, but in the next annual monthly rebalance, we let's discuss all of those findings with everyone here. So let's do that, cover that in the next month's webinar, because that analysis we are still doing. So we'll finish that and we'll share with everyone here.
Sure. Uh, if you guys have any more questions, okay, we have more questions. Which sector do you see will perform best next year, which means this year? What are
Yeah.
your expectations for 2026?
Yeah. So, see, regarding sectors and regarding predictions, uh, again, we don't try and predict what is going to happen. Our methodology, the way we work is we try and adapt to what is happening. So, if tomorrow, let's say, metals work, we are going to be present in that. Right? That's the way our methodology is supposed to work. Obviously, it won't work all the time, but that's how it is supposed to work. That any sector, any stock that is trending should come up in our portfolio. Uh, so the way methodology works is we try and adapt to the changing market conditions, and there's no way we can predict the market. We can predict that specific which sector is going to do well really. So yeah, we don't really predict that thing. We have never said it in the past that this specific sector is going to do well. We don't have that kind of uh, capability. But what we try and do is whatever is working, we try and be present in that specific sector or stock. So adapt more than predict, really.
Another user is asking, have we compared the performance of our multi-factor strategy against other factor-based funds?
Other factor-based, you mean the mutual funds?
Yeah, I think we did a thorough analysis on this based on long-term historical trends of Nifty Smart Beta funds, which are based
Mhm.
on single or two
Yeah,
factors. And we also did that. We don't have that data handy, but I have noted this down. We will definitely present this information in the next rebalance. But if
yeah,
we talk about the Nifty indices Smart Beta funds, our methodology is multi-factor, so it's much more consistent than the cyclicality of performance that we see with single factor beta funds. And we will present this data uh, in the next rebalance, where you will be able to see how fluctuating the performance of single beta factor funds can be, whereas our funds is much more consistent, and thus overall on a CAGR basis it tends to outperform. Sure, we will compare all the multi-factor beta
yeah.
funds
That
as
will
well.
be a good exercise that we can do and share in the next call.
Yes, Navi, we will be on time next month. That is our promise. This time, in fact, we were just a couple of minutes late. What happened was another webinar was scheduled, and from the back end, mistakenly, we went live on that link instead of the original link. As a result, we were 12 minutes late. But we promise from next time we will be on time. So another user is asking. We were the most SIP'd and most invested small case earlier, but we are not in that list anymore.
Yeah.
Uh, I guess that's just a comment, not a question. Okay, so another user is asking about the market cap allocation for uh, our current portfolio for the January month.
So I can, one second, I'll close that file. So market cap allocation, we have reduced our allocation to large caps and increased it in small and mid cap. So as of now, we are at 13% in large cap, 45% in mid cap, and 42% in small cap. That's what the allocation as of January.
Okay, we seem to have answered all the questions. We can wait a couple more minutes. If you have any
Sure.
more question, please drop it in the chat and we'll address that. Um,
Okay.
yes, mid cap and small caps have performed poorly. In fact, small caps index itself has performed quite poorly. We have slightly outperformed. Our small cap fund has slightly outperformed the index, but in mid cap sector, we have underperformed. Uh, Satvik is asking, don't you think we should stick more towards large cap instead of small cap and
See,
mid cap?
as a, yeah, I understand why you're saying, because what we hear is, and what is the fact also, that as an index, large cap index looks more reasonably valued, whereas mid cap and small cap, even after the correction we have seen, they're still looking quite expensive. But that is index as a whole. Obviously, we don't look at it as an index whole, but we do look at it components of index. And what we are seeing is definitely there are few opportunities that are there in mid and small cap. Now, our fund is not, ours is a very really small fund. Uh, it's not like it has 50,000 or 1 lakh crore kind of AUM, because then you really can't go after those very small opportunities that might be there in mid or small cap. You really need to look at opportunities at scale. And that's why those kind of funds you see are majorly into large caps. But for us, even if those are very, very small stocks, because of our size, we can actually take exposure in those kind of very small opportunities, which might be really undervalued, so to say. And that's why we have increased our allocation to those specific stocks. But as an index, I totally agree. I totally agree that if you have to put your money in index funds, then at this point it looks like that large cap index as a whole is fairly valued.
A user wants to see the factor slide again.
Okay, sure. Yeah. You can see my screen?
It should come up any second now. Yeah, it's visible now.
Yeah. So we have quality 24% and value 76%.
And it's important to understand that these are broad bara type factors. Within individual factors, there are multiple parameters. So in total, we have over 700 parameters that are broadly categorized into these five bara types. And based on that, we make the decisions of which stock to buy. Every stock is scored on all the factors.
Yeah.
Okay, Vivek, I think we have
Okay.
answered all the questions. Thank you so much for joining. And in case you want to revisit any particular sections from the webinar, the recording of the webinar would always be available within the Gulaq YouTube channel. So you can always visit that. And thank you to you, Vivek, for joining and
Thanks.
taking
Thank you,
us through
everyone.
the.
Thank you, Ankit.
Okay. Thank you, everyone. Bye.